Everyone. Hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's just dive right in, take a look, see what's going on today. If you want to follow me, it's at _finance. And if you want to join our community, finding-value.com, I dive deeper into all these topics and subjects, looking for investment opportunities, sharing those opportunities with everybody in the community. I do take a longer term approach. My entries are timed; they are not at random. So it's not like I put 30% in precious metals, 20% in oil. That's not how I do it. I look for things that are down and cheap, undervalued, good technical setups, and I pinpoint to some degree. Not It's not pinpoint, but I get an area of accumulation where I can accumulate these undervalued assets with good technicals. If that's something that interests you, definitely try it out. Special with a coupon code, you get a discount, 50% off the first month only on the monthly membership, and a larger discount on the yearly. I will be releasing a midweek update. It should be released for you guys today. So check it out. And that's where I dive into the opportunities, individual companies, or even ETFs, and give my opinions. Warren Buffett once said, "My success over 58 years was mainly the result of about a dozen truly good decisions." Here are the 12 investments that made Buffett the best investor of all time. It says, "In 58 years of Berkshire management, most of my capital allocation decisions have been no better than so-so. Our satisfactory results have been the product of about a dozen truly good decisions. That would be about one every 5 years." So if you go back and you look and see just how good or bad, however you want to look at it, Warren Buffett's decisions were as he was going through, you figure out how he made his money. And I mean, I can sum it up here real quick for everybody. He didn't make his money by having a high probability of success. In fact, his success rate was very low. And what is low? I'm talking like it was under 50% success rate. What he did do is that he had a couple of those picks that were incredibly good, and he weighted them pretty good. And then he held on to them for his entire life, which then threw off lots of other cash that he could go and invest in other opportunities. So to him, over his entire life, there was truly about a dozen good decisions in there that made him all of his money. He might have had 300 investments and 12 turned out to be incredibly, ridiculously good. And then he rode those ridiculously good ones so dang hard that he turned thousands and thousands and thousands of percents on those 12 or so good decisions. So a lot of people will get discouraged. They'll be like, "Well, what about this one that isn't working out?" And they wait like 2 months. Some people wait like 2 or 3 or 4 months. They're like, "Oh, this isn't working out." It's like, number one, your time frame is too short. Number two, uh, you have to buy enough across a good mix where the losers don't matter. It's the winners that matter. So you want to get into and ride them for very long periods of time. Most people, if you can't ride something for very long, you shouldn't be in the stock market. You might as well just throw it on red or black at Vegas and spin the wheel or whatever you want to do. I mean, that's really what you're doing if you're trying to play the short term. The short term is all emotional, news-based movements. Longer term, it's more movements based off fundamentals and cycles. And what I'm trying to do is match cycles and fundamentals together. And that's where you can see the cycle through the valuations. So if you can see that entire sectors, like all of uranium, all of oil, all of a variety of different commodity sectors are all undervalued, well, then you know that the commodity cycle is at its low. Conversely, you know that it's at its high if the valuations are all expensive and they're cash flowing like mad. The financial assets right now are all overvalued, and that's why Buffett, I don't think he's pumping money back into the market, is because he can't deploy the size of money that he has into the companies that are available that are undervalued. So he has to put it into cash or somewhere else. Natural gas, the summer that never was. So we had a disappointing summer in terms of electricity demand for cooling. So we are running at the upper end for natural gas storage. And this is where we get the more bearish outlook for the pricing because we're getting some pullbacks in that gas. But around this time frame, somewhere in here in the fall, we're going to get one heck of an opportunity to buy some natural gas companies that have fallen back down. And I think that's going to be a good opportunity here. Now, I know Eric Nuttall did the exact opposite. He went after natural gas, and natural gas is it's very dependent on weather. Weather being warm in the summer and cold in the winter. So I don't think I don't think that was the right move in my opinion. I would have rather purchased oil when everybody hates oil, which is a little, just a little while ago. When he swapped all that stuff, I would have done the exact opposite of him. I would have not gone into natural gas, which we didn't, and then I would have gone more into heavy oil and some of the energy service companies. Because I think even now we're still kind of at that bottom for them. Palantir isn't just expensive, it's the most expensive stock in the entire S&P 500 based on forward PE and PS. Is this sustainable? So this is Palantir. It's way up there on a price to sales and a price to earnings ratio. It's expensive on both fronts. Probably because there's a bunch of insider crap going on with government giving them a lot of contracts to basically spy on people and turn us into a country that isn't as free as it used to be. Boeing is very expensive on a price to earnings perspective. Tesla is very expensive. You can see Nvidia up here too, which is expensive on a price to sales ratio, not as expensive on a forward price to earnings ratio as some of these other ones. But this is where I get turned off. If someone said, "Hey, you gonna go buy Palantir?" No, not even close. Would I go buy Boeing? No, I wouldn't. I wouldn't buy Boeing either, and I wouldn't buy Tesla. I wouldn't buy Nvidia even with the price to sales of that expensive. Now, could they grow out of it? They could. It's possible, but the whole sector is overvalued. The whole area. Now, could it still go up? It very well could. Here's some things to consider. All right, and this might be different. You can say I could say something like this stock company A is not a good invest. It wouldn't be a good investment because you'd be paying too much for it. And then the stock goes up 2x, and someone would say Andy or whomever is wrong to have that opinion. But you're not wrong. Just because something's expensive doesn't mean it can't go up. And just because it goes up doesn't mean you should be in it. Does that make sense? So you're going to let some things elude you. Like you'll let them go and you will miss them. And that was the right decision to make. I see this all the time on Twitter. And I don't know if people understand. So if a company goes up 5x or even a 10x and you were not in it, that's completely okay. Why is it okay? Because maybe it didn't have any value to begin with. And the company went up 10x because of money flow, somebody pumping it on Twitter, so to speak. But it doesn't mean that you should be in it from a statistical probability perspective. Now, what if, and this is what all the greats will tell you, what if you avoid all those? You don't get any of them. And there's a whole bunch of companies that you're avoiding that aren't doing 10Xs. They're going down 80, 90%. Now, what if you stick with ones that are a little bit more value oriented? So you buy those and you wait. And yes, you can get 30% declines in them still. But what if you get a higher probability of success? What if you went from a 10% probability of success and you move the needle towards 60, 70, 80% probability of success? And your probability of rewards is not much less than the speculative stuff. What if you're still getting an 8 or 10x upside rather than the small ones that do minus 90%, or maybe they go up 5 to 20x, but only 10% of those do? What I'm doing is I'm playing a statistics game. So not all companies that don't, not all the companies that don't fit the criteria that I like, some of those companies can still do very crazy things. I'm just not in them. Does that make sense? So you're playing a harder game from a statistical probability perspective on some of the companies. And I would rather take less risk, get roughly the same reward, but have a higher probability of success. Now, I say this, can you measure these things with accuracy? No, you can't. You can't measure what I'm saying with accuracy, which makes it difficult. They're all kind of like off the cuff, deals here. It's more of an art than a science, is what Peter Lynch would tell you. But I also think that there are traits that companies have that increase the probability of success. It's the traits that you're looking for. Warren Buffett says the fact that people will be full of greed, fear, or folly is predictable. The sequence of those is not predictable. So in the short term, we don't know what that looks like. The sequence, is it greed, 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 fear, folly, greed? Or, the sequence of how that works. What they have found is the most reliable thing is to buy undervaluation, to pay less for assets than what the assets are worth. And then you wait for the market conditions to come into cycle. Now, the technical analysis will just help us get an undervalued company at hopefully a good price that's bottoming out. So it helps us determine maybe when that bottom could be. Not perfectly, but around there. And then you have to wait. Ian Castle says, oftentimes your next big winner is already in your portfolio. We're always searching for the next thing, but maybe you already own it. Maybe you should add to existing companies that are already in the portfolio. Another one from Winston Wolf. He says, has anyone else seen a pentuple, which is 5, top before? Because I haven't. Yeah, we're getting a whole bunch of resistance here. Hit, 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 hit. We're trying to break through that resistance. And this is gold. Gold's trying to break through. I do think it will break through eventually, and then we'll run. Even if we have a little detour lower, I don't think it matters, guys. So many people are so focused on the short term that the entire long-term big bull market completely eludes them. Tell me why gold should go down. And they'll say, oh, it's going to be a recession. It's all these short-term market things. Like, no. Tell me why gold's going to go down for the next 5 years, 10 years. Tell me a solid case where your currency supply will go down. And show me a time in history where this currency supply went down. Tell me how we're going to meet our debt obligations without printing money. I mean, it's as simple as that. And then all of this short-term stuff just floats away. It just doesn't matter. You just sit. Brandon says, what is your craziest but high conviction investment idea right now? Something you're embarrassed to even write in public. Let's hear it. Well, I don't know if I have anything that I'm embarrassed to write in public, but I think some of the best, highest conviction investment ideas is oil. I think oil looks good. I think lithium looks good. I think the entire energy space is good. Now, is that crazy? No, I don't think so. But I don't know of anything that's crazy. And if it was too crazy, I probably would avoid it because I don't need to take on that absorbent amount of risk if it's that crazy in terms of risk. Tom Engel has lived off his portfolio for 40 years. How? He's an incredible investor with a brilliant cash management strategy. Here's how exactly it works step by step. You build cash when things are overvalued, and you buy bargains when they're undervalued. That's exactly what we're doing. This here, depending on the time frame, it cycles up and down. Commodities, stocks, commodities, stocks, commodities in terms of bargains. Now, when things are in between, you may have to build cash. If this was a commodity to stock ratio. If it's just a company, then build cash, buy pullbacks. So buy the dips, hold the rips on an upward value that the business creates. David Burrows says increased chances of a U.S. rate cut and a weaker dollar are kindling the fire in global stocks. The MSCI EX excluding U.S. is following through versus U.S. equities. Stronger breadth and superior momentum is this under-owned cohort. Asia, LATAM, Canada, and parts of Europe are all rallying, and they also rally during commodity bull markets. And this is the beginning of it. You can see the volume kick up. You can see the downtrends are breaking. We're starting to move higher. This is the beginning of this double bottom breakout to move higher in a lot of these different sectors. And they're all analogous with a commodities bull market. Like they all move together. Another one from Ian, he says, the great companies execute on the basics. They don't tell you everything and then surprise you with new things you never knew they were working on. Mediocre companies can't execute on the basics, so they tell you everything they are working on and surprise you with disappointment. That's true. Go listen to some of the earnings calls. The crappier companies, they tell you everything. The great companies, they tell you kind of what they're doing with like where they like what they've executed, they've got cash, and then what they're doing with the cash. Basically what they tell you. Bullish oil. So there are only 2 times in history where the oil and S&P 500 ratio was lower. 1999 and 2020 were the only 2 times in history where this ratio was cheaper. You could also state that oil is cheaper on the basis of a gold to oil ratio as well. Patrick says, I've shown you this many times. All you need to understand about silver is that it tracks gold's trend versus inflation. And yeah, these are also possibly the greatest combo of yearly chart breakouts, silver pending 2025 close, you will ever see. Once in a lifetime baby. So gold adjusted for inflation is broken out, and silver tracks it, and it's breaking out here on a yearly time frame. So yeah, these look fantastic. And this is what the problem is going to be with most people. They're going to look at the short term and try to trade the short term. That's not what you want to do. You buy a whole bunch of assets. Like here, it bottomed in 2016. I bought a whole bunch in 2018 for silver. And then I've just been holding the entire time. Like in the Jesse Livermore book, the old guy who was the investor, he kept saying, we are in a bull market. So from 2016, I would say from silver, we are in a bull market. We are in a bull market. We are in a bull market. Now, that doesn't mean the equities are going to go up because we've started kind of an upward trend in both gold and silver from that point. now that we are hitting more critical areas where we're starting to get above the cost curves, now the miners are going to start to play with this. So when someone says, when is it time to sell? We just broke out. I mean, that's like saying you're going on a 1,000-mile ride. You just get in the car, and then the first question you ask at the first stoplight getting out of your block is, when are we going to get there? And you ask every single little time, are we there yet? When are we going to get there? Are we there yet? And it's like, look, we just broke out, guys. This is going to go up. It could be for many years. It could be a decade. It could be 2 decades. It could be 4 decades. It could go up for the rest of my life. Are we there yet? Are we there yet? Are we there yet? Should I sell yet? What's our exit plan? How should we exit this? Guys, the damn thing just started. It just broke. I've been in this for like six or no more than that, 6, 7, 8, 9, at least 9 years with a lot of money. Are we there yet? Are we there yet? Here's Sam Gatling. It's go time for Franco Nevada. No, it's not. Go time was like down here when you could have bought it cheap as crap. This is when they had one of their bigger royalties down in Panama with copper got hit. You want to buy when there's a problem. That's where we bought. We bought here, all through here, on our website here with Franco Nevada. Now, I don't mention it anymore because it's gone way up. We're up massively in it. It's one of my larger positions for a royalty company. I've got 3 big ones. And I've just been sitting in, doing absolutely nothing. Now, all the technical analysis guys, oh, it's a buy way up here. It's at 175. Well, why didn't you buy it down here when it was like at $100, $110? That's when things get really good. And now you're up, 60 something percent. Perfect. Eric Nettle, after decades of flattish growth in demand, U.S. electricity demand is forecast to grow by 31% over the next 15 years. Natural gas has gone from a bridge fuel to the fuel of choice to satisfy much of this growth going forward. Affordable, available, and reliable. More natural gas is required to feed growing electricity demand. We have rapid increase in electricity demand, up 5% per annum from 2010 to 2024. 31%, 2025 to 2040, is driven by the emergence of large load data centers and EV growth is what they've got. So we have a lot of electrification of heating and transport, data centers, and AI-driven future will create unprecedented growth in power demand. You know what else I think is going to be good? I think coal's going to do very well. I don't think we're going to displace much of anything. I think we're just going to keep adding and adding and adding because our thirst for energy is going to go up exponentially. And we're not going to be able to meet it. We're going to be energy constrained for maybe even the rest of my life until we figure out a way to, push the boundaries of how much energy that we can produce. I don't think we're there yet. Meanwhile, this is from Tabi. The Brazilian real is currently breaking a key resistance this month, its second strongest major currency year to date. Emerging markets are waking up and most investors remain oblivious, in his view. Guys, when this breaks, it's going to light these emerging markets on fire. They are going to rip. They're going to rip because a lot of these companies, they have both real and USD debt. Depending on how much USD debt they have, if the currency appreciates rapidly, a lot of their income is earned on the real, and then they pay their debts in dollars. So if you get a gigantic real versus dollar rally, their debt essentially gets devalued through currency exchange rates. If you look at some of the currency exchange rates back in history, they have moved dramatically over commodity bull markets, multiple hundreds of percent moves. And then that amplifies the move of whatever they're selling. So their debt gets devalued massively. And at the same time, if they're selling a commodity that's gone up 10x, then you get a result of 10, 20, 30, 40, 50, 60, 100 times your money. So that's a lot of the emerging market countries are like this. And it deals a lot with currency exchange rates. Freight futures AM update, dry bulk, Capesize up 2%, Panamax up 1. Tankers, VLCC is down 2%, Suezmax is down 1%. We've got the U.S. oil rig count didn't start to fall in earnest until May 4th of 2025. It takes at least 6 months to impact the data. Be right, sit tight. 6 months to impact the data. And the markets are going to have to try to figure out how to manage all this. So that's where I think I'm going to end it there. That's all I've got for today. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Special is a coupon code. I have released the midweek update, so look for that. It's on the website of what I like and what's down, and what I be doing with my money. So you can watch that if you'd like to watch that. And that's all I've got. So we'll catch you next time. This is Finding Value.